Let me begin with a question that cuts to the heart of global politics. What happens when the most dynamic rising power in the world begins planting deep roots in the very hemisphere long claimed as the United States' own backyard? We are not talking about distant Asia or Africa. We are talking about Latin America, specifically Venezuela, a nation sitting on the single largest pool of proven oil reserves anywhere on the planet. When China steps into Venezuela, it is not simply signing contracts. It is rewriting the rules of global power. For over a century, Washington maintained dominance in Latin America with a mixture of pressure, intervention, and economic control. The Monroe Doctrine was its unspoken license. Latin America belonged within the U.S. sphere, off limits to outside powers. Yet, here we are in a moment where China openly enters that sphere with financing, infrastructure, and long-term oil agreements, precisely where Washington has chosen sanctions, punishments, and isolation. That contrast matters, because while the United States closes doors, China opens them, and every door that Beijing opens is more than economics. It is political theater, it is symbolism, it is leverage. Let us be clear, Venezuela is not an accidental partner for China. It is a calculated choice. Cut off from global markets by U.S. sanctions, Venezuela became the perfect candidate for China's strategy of investment without conditions. Beijing offered loans repayable in oil, built housing, upgraded infrastructure, and secured energy shipments at discounted rates. What Washington cast as isolation, Beijing turned into partnership. What the U.S. framed as punishment, China reframed as opportunity. And in that reframing lies the profound global shift we are living through. When the United States deploys sanctions, it does so under the belief that it is exercising one of its most powerful tools of global influence. Sanctions are meant to isolate, to punish, to weaken governments deemed adversarial to Washington. They are presented as a nonviolent alternative to war, a method of bending another nation to the will of the United States without sending soldiers into battle. For decades, sanctions had devastating effects precisely because targeted states often found themselves with no escape routes. The global financial system was dominated by American and European institutions. Access to credit, trade, and markets passed through channels the United States controlled. That meant when sanctions fell on a country like Venezuela, the expectation in Washington was that the state would suffocate economically, that it would be forced into compliance or collapse entirely under the weight of economic isolation. But this calculation assumed that the United States remained the unraveled center of global finance and trade. It assumed that no other great power could or would step in to replace the relationships Washington had severed. That assumption is now collapsing in real time, and nowhere is that more evident than in Venezuela's embrace of China. China has looked at the landscape of sanctioned states not as pariahs to be avoided, but as opportunities waiting to be seized. Where Washington shuts off access, Beijing offers alternatives. When U.S. sanctions prevent access to dollars, Chinese banks and institutions step in with loans, often repayable in oil or commodities rather than hard currency. When Western companies refuse to build infrastructure, Chinese firms arrive with financing engineers and construction crews. Where U.S. diplomats insist on political reforms as preconditions for aid, China strips away the conditions and focuses on pragmatic exchanges, oil for loans, housing for contracts, railroads for resources. This reversal is why one can say China turns U.S. sanctions into opportunity. What Washington designs as an iron cage, Beijing transforms into an open door. In the Venezuelan case, the United States expected that sanctions on oil exports would strangle the government's finances. Without the ability to sell oil, the country's main source of revenue, the state would starve. That, in turn, would force political change, perhaps even regime collapse. Instead, China stepped in and offered to buy Venezuelan oil, often at discounted prices. Caracas accepted because it desperately needed revenue, and Beijing accepted because it desperately needed oil. The match was perfect. Washington's cage became Beijing's ladder. Every barrel of Venezuelan crude shipped to China became not only a flow of energy, but a transfer of political capital. The sanctions meant to isolate Venezuela had instead handed Beijing privileged access to one of the most resource-rich nations on earth. And it did not stop with oil. China extended loans to Venezuela, sometimes structured so that repayment came in shipments of crude rather than in cash. This arrangement allowed Caracas to secure funds despite being cut off from Western credit markets, while giving Beijing a guaranteed flow of energy resources. The same sanctions that froze Venezuela out of international finance created the space for China to entrench itself as the indispensable partner. What Washington designed to weaken its rival, Beijing transformed into a platform to strengthen its own position. This inversion illustrates the deeper truth about the shifting global order. Sanctions rely on the absence of alternatives. They are effective only when targeted countries cannot find other sources of financing, trade, or investment. The rise of China, however, undermines this foundation. Beijing has the capital, the industrial base, and the geopolitical ambition to provide alternatives. By offering infrastructure, financing, and trade where the United States offers only punishment, China not only gains influence but demonstrates to the world that American power is not absolute. It signals that sanctioned states can survive and even thrive if they are willing to pivot eastward. For Venezuela, this lifeline has been existential. Cut off from the United States and Europe, its economy teetered on collapse. China's involvement provided the cash flow, infrastructure, and partnerships necessary to sustain the state. For Beijing, the calculus is equally strategic. By investing heavily in Venezuela at a moment of Western withdrawal, it ensures loyalty, secures long-term oil contracts, and establishes itself as a counterbalance to U.S. influence in Latin America. The sanctions that Washington viewed as a stranglehold became the very conditions that allowed China to expand its reach into the Western Hemisphere. The mechanics of this dynamic are revealing. Sanctions block Venezuelan oil exports to Western markets. Chinese firms step in to buy the oil at discounted rates. Sanctions freeze Venezuela's access to the dollar-based financial system. Chinese banks extend credit denominated in yuan or tied directly to commodity repayment. Sanctions halt infrastructure financing from Western-led institutions like the IMF or World Bank. Chinese state-owned companies build ports, housing, and transport systems. Every step of American withdrawal creates a vacuum, and every vacuum becomes a new entry point for Beijing. It is not charity. China's actions are calculated investments in long-term influence. The loans tied to oil shipments guarantee energy security. The infrastructure projects lock Venezuela into dependence on Chinese technology and expertise. The trade flows establish patterns that will last decades. But the point remains, none of this would have been possible without Washington's sanctions. By shutting off Venezuela's access to its traditional partners, the United States unintentionally opened the door for its chief rival. The implications reach beyond Venezuela. Iran, also under heavy U.S. sanctions, has deepened ties with China in similar ways, trading oil for investment and integrating into Chinese-led projects like the Belt and Road Initiative. Russia, targeted by Western sanctions after the annexation of Crimea and the invasion of Ukraine, has likewise turned to Beijing for economic and financial partnerships. The pattern is unmistakable. Wherever the United States seeks to isolate, China seeks to embrace. What the U.S. closes off, China turns into opportunity. The effectiveness of sanctions declines not because they hurt less, but because the rise of an alternative power blunts their impact. This undermines not just American strategy in specific countries, but the very architecture of its global power. For decades, sanctions worked because the global economy was organized around U.S.-led institutions. Now, with China offering an alternative, sanctions risk backfiring. They no longer prove U.S. dominance, they expose its limits. Each new case where Beijing rescues a sanctioned state erodes the aura of inevitability surrounding American power. It teaches governments that survival without Washington is possible. It teaches them that the costs of defiance are not absolute, that there are exits from the cage. In this sense, sanctions intended as tools of punishment evolve into recruitment tools for Beijing. Every government punished by Washington has an incentive to explore ties with China. Every deal signed in defiance of sanctions strengthens Beijing's global image as a counterweight. The more the United States leans on sanctions, the more opportunities it hands to its rival. Oil has never been just a source of energy. It has always been a form of power, a lever that governments and empires use to shape the world around them. To speak of oil as merely a commodity is to misunderstand its role in the architecture of modern society. Every plane that flies, every ship that carries cargo across oceans, every truck that delivers goods on highways depends on oil. It is not an accessory to the global economy. It is its bloodstream. Whoever controls access to it or guarantees a reliable supply of it holds more than barrels in storage. They hold leverage over nations, industries, and the rhythms of global life. This is why Venezuela's reserves, the largest on earth, matter so profoundly. They are not just barrels of crude locked underground. They are bargaining chips in the contest of global power. For decades, the United States understood this logic better than most. Washington built its dominance in no small part by ensuring favorable access to oil and by cultivating relationships with key producers such as Saudi Arabia. Oil not only powered the American economy, it became a weapon of foreign policy. Allies received security guarantees in exchange for steady supplies, while adversaries found themselves squeezed out of the system. The structure of global energy trade became an instrument through which U.S. dominance was enforced. Sanctions, blockades, and market manipulation all relied on oil's central role. As long as Washington could keep oil flowing through its preferred networks, it could dictate terms to much of the world. But here lies the shift. China has emerged as the world's largest oil importer, surpassing even the United States. Its economy, industrial base, and global manufacturing role are sustained by a steady stream of energy imports. For Beijing, oil is not only a matter of commerce, but of survival. Without it, factories stop, trade slows, and growth collapses. And unlike the United States, China does not enjoy abundant domestic reserves. Its survival depends on securing reliable, affordable supplies from abroad. That is why Venezuela, with its colossal reserves and its isolation from Western markets, is not just another trading partner for Beijing, it is a strategic lifeline. The United States, by imposing sanctions, effectively barred Venezuela from selling oil to its traditional buyers. This created desperation in Caracas. It also created opportunity for Beijing. China could step in and purchase oil at heavily discounted rates. For Venezuela, this meant survival. Money continued to flow even if reduced. For China, this meant energy security on favorable terms. Oil was no longer simply being traded, it was being converted into leverage. Beijing could lock in long-term supply contracts that ensured a steady flow of crude for decades to come, at prices shaped not by open markets but by political necessity. This arrangement serves China in multiple ways. First, it shields Beijing from volatility in global oil markets. With secure contracts from Venezuela, China insulates itself from price shocks or geopolitical disruptions elsewhere. Second, it weakens the leverage that the United States once held through its dominance of global oil flows. By diversifying supply chains and securing producers outside Washington's orbit, China reduces its vulnerability to American pressure. Third, it builds political capital in Latin America, a region the U.S. long considered its uncontested sphere of influence. Old deals become more than economic exchanges. They become symbols of defiance against Washington and of Beijing's willingness to offer alternatives where the West imposes constraints. Oil as leverage becomes clearer when one considers its psychological impact on other states. For years, governments under U.S. pressure feared isolation from global markets. Now, when they look at Venezuela shipping millions of barrels to China despite crushing sanctions, they see another possibility. They see that oil reserves, once weaponized against them, can instead become bargaining chips. If Caracas can survive by leaning eastward, why not Tehran? Why not Moscow? Why not any country cut off by Washington's dictates? The more oil flows eastward under these terms, the more nations view China not just as a consumer, but as a shield against isolation. What makes oil unique is that it is both indispensable and limited. Renewable energy may be rising, but the infrastructure of the global economy still runs overwhelmingly on fossil fuels. No alternative energy source yet provides the portability, density, and reliability that oil does for aviation, shipping, and heavy industry. This gives it a strategic weight far beyond its market value. Venezuela's reserves, larger than those of Saudi Arabia and Russia, represent a treasure chest of this strategic resource. In aligning itself with Caracas, China is not just purchasing fuel, it is embedding itself into the geopolitics of oil itself. Every shipment, every contract, every infrastructure project tied to Venezuelan crude locks Beijing deeper into the global chessboard of energy politics. Oil also functions as leverage in the way it reshapes relationships between great powers. For decades, the U.S. could rely on Saudi Arabia and the Gulf states to anchor its energy strategy. But now, with Venezuela drifting toward Beijing, Russia aligning with China in energy deals, and even Gulf producers seeking greater independence, the old alignments are loosening. This fragmentation weakens the U.S. ability to use oil markets as a geopolitical weapon. If too much of the world's supply is tied to or friendly with Beijing, then Washington loses one of its sharpest tools. In that sense, oil ceases to be a unipolar weapon and becomes a multipolar bargaining chip. For Venezuela itself, this leverage is double-edged but powerful. Its oil wealth has long been a curse, inviting intervention, corruption, and dependency. Yet under current conditions, those same reserves offer it a shield. China's hunger for oil transforms what might otherwise be stranded assets under sanctions into instruments of survival and negotiation. Caracas can use its crude to secure loans, infrastructure, and political backing, even as the West seeks to isolate it. The very resource once used to tether it to American influence now becomes the means by which it escapes that influence. The symbolism of this cannot be overstated. Every tanker that sails from Venezuelan ports to China carries more than crude oil. It carries a message. It says that sanctions are not absolute, that survival is possible, that the U.S. no longer controls the lifeblood of the global economy as it once did. For nations in the global South, this message resonates deeply. Oil becomes not just energy, but proof of alternative pathways. It tells countries under U.S. pressure that there is another door open, one that leads not to collapse but to survival, if they are willing to align with Beijing. In this context, oil becomes a tool of diplomacy as much as a resource of commerce. China secures its supplies, Venezuela secures its survival, and both together weaken the narrative of U.S. dominance. Oil contracts replace treaties, shipping routes replace military bases, and energy flows redraw the map of global alliances. What might appear as economic pragmatism is in fact the construction of a new geopolitical order, one barrel at a time. For much of the past century, the international system operated on the assumption that there was one commanding power at the center of global affairs. After the Second World War, the United States consolidated its position as the dominant military, economic, and political force. When the Soviet Union collapsed in 1991, that dominance appeared to be absolute. Commentators began speaking of a unipolar world, one in which Washington could dictate terms across continents, shaping institutions, alliances, and economic flows to its advantage. Countries that opposed this order often had little room to maneuver. They were either crushed through isolation and sanctions or brought back into line by promises of aid tied to strict conditions. The International Monetary Fund and World Bank enforced economic orthodoxy, NATO and U.S. military bases guaranteed strategic supremacy, and the dollar reigned as the unchallenged medium of global trade. The world had few choices, but history rarely stands still. As economies grew outside the Western orbit, new poles of influence began to emerge. China's rise from a manufacturing hub to the second largest economy in the world shattered the illusion of permanence and unipolarity. Russia's resurgence, India's demographic weight, and the growing assertiveness of regional powers across the Middle East, Africa, and Latin America further accelerated the erosion of a single global center of gravity. Multipolarity, once an abstract theory, has become a lived reality. Countries now find themselves navigating among several competing centers of power rather than bowing to one. And Venezuela's partnership with China is a vivid demonstration of this transition. When Washington imposed sanctions on Venezuela, it assumed the government in Caracas would eventually bend or break. In a unipolar system, that might have been true. Sanctioned states had nowhere to turn, no alternative sources of finance, no rival institutions willing to defy Washington's orders. Isolation was effective precisely because the United States and its allies controlled the gateways to global trade and finance. But multipolarity changes the calculus. With China willing to provide loans, purchase oil, and fund infrastructure, Venezuela suddenly had an alternative pathway. It was no longer trapped in a binary of compliance or collapse. It could choose alignment with another power. That ability to choose is the essence of multipolarity. What makes multipolarity powerful is not only the redistribution of material capabilities, but also the psychological shift it produces among governments. Leaders in countries once thought of as dependent now recognize that they can play powers off one another. They no longer have to accept Washington's conditions as the final word. If the United States demands austerity in exchange for aid, China offers financing tied only to resource agreements. If Western institutions insist on political reforms, Beijing refrains from such demands, framing its involvement as pragmatic and non-interfering. The very existence of this contrast reshapes the bargaining environment. Multipolarity multiplies options, and options are power. Venezuela's embrace of China is not an isolated event. It signals to other nations under pressure that alternatives exist. Iran, subjected to decades of U.S. sanctions, has deepened ties with Beijing and Moscow. Russia, facing unprecedented isolation after its invasion of Ukraine, turns eastward for markets and financing. Even countries not directly sanctioned, such as Brazil or Argentina, increasingly weigh Chinese partnerships against U.S. and European ones, calculating where the best opportunities lie. Multipolarity, therefore, manifests not just in great power rivalry, but in the daily decision-making of governments across the global South. The decline of unipolarity can also be seen in the shifting legitimacy of international institutions. In a world where the IMF or World Bank once held monopoly power over development financing, China's Belt and Road Initiative now competes by offering infrastructure investments on a massive scale. The Asian Infrastructure Investment Bank provides loans outside of Western-led frameworks. Even currency arrangements are beginning to diversify, with more nations exploring trade settlements in yuan or regional alternatives rather than relying exclusively on the dollar. These shifts weaken Washington's ability to enforce compliance through financial instruments. In a multipolar world, sanctions lose some of their sting because alternative lifelines exist. The symbolic importance of multipolarity cannot be underestimated. For decades, the United States maintained a sense of inevitability around its dominance. Governments were told, implicitly or explicitly, that survival outside of Washington's order was impossible. The collapse of the Soviet Union seemed to confirm this narrative. But when Venezuela demonstrates that even under crushing sanctions it can survive by aligning with China, that inevitability is broken. The message resonates far beyond Latin America. It tells countries in Africa, Asia, and the Middle East that they need not accept U.S. dictates as destiny. Survival and even development are possible through alternative partnerships. Multipolarity also changes how smaller nations perceive risk. In a unipolar world, defying Washington was a gamble with catastrophic consequences. In a multipolar world, defiance becomes a calculated risk that can be offset by support from other powers. This emboldens governments to pursue policies that would have been unthinkable in the 1990s or early 2000s. They can balance, hedge, and maneuver rather than submit. Venezuela's choices embody this broader shift, turning its oil reserves into bargaining chips not only with China, but potentially with other powers willing to defy Washington's sanctions. For the United States, the rise of multipolarity is deeply unsettling. Its tools of control, sanctions, conditional aid, military alliances, were designed for a world in which alternatives were scarce. Now, each attempt to isolate an adversary risks pushing that adversary further into the arms of Beijing, Moscow, or other emerging powers. Instead of enforcing compliance, sanctions accelerate diversification. Instead of weakening rivals, they strengthen alternative networks of influence. This erosion of effectiveness exposed the fragility of unipolar power. China, for its part, understands the symbolic and strategic value of multipolarity. By positioning itself as a partner that respects sovereignty, avoids political lectures, and offers tangible economic benefits, it appeals to nations wary of decades of Western conditionality. This appeal is amplified when China's involvement demonstrates real survival strategies for sanctioned states. Venezuela's resilience becomes not only a bilateral success story, but also a global advertisement for Beijing's model. The more this model spreads, the more entrenched multipolarity becomes. Multipolarity is not merely the coexistence of several powerful states. It is the reorganization of global politics into a marketplace of influence rather than a monopoly. Nations now shop for partnerships, weigh competing offers, and leverage their own assets to strike better deals. Oil infrastructure contracts, military cooperation, and trade routes all become bargaining chips in this new landscape. The monopoly of power once held by Washington is giving way to negotiations among multiple players. This does not erase conflict, it multiplies it, but it also multiplies agency for smaller nations. Venezuela embodies the practical realities of this transition. Its alignment with China shows that even a state once strangled by sanctions can chart an alternative course. It demonstrates how multipolarity reshapes the cost-benefit calculations of governments across the global South. And it underscores how far the world has moved from the unipolar moment of the 1990s. For Washington, this represents not just a geopolitical challenge, but an existential one. If countries can survive without U.S. approval, the very foundation of American global leadership begins to erode. Contracts can carry as much weight as armies, and investments can reshape borders without a single bullet fired. The history of American power in the Western Hemisphere illustrates this clearly. For over a century, Washington relied not only on military might but on covert interventions, coups, and heavy-handed diplomacy to maintain control. From Guatemala in the 1950s to Chile in the 1970s, governments that defied U.S. interests were destabilized or replaced. These interventions cemented the idea that Latin America was not free to chart its own course, but bound to the rules of an external power. The Monroe Doctrine, first articulated in the 19th century, evolved into a practical policy of hemispheric dominance. No outside powers were to interfere, and no Latin American country was to resist for long. Yet in the 21st century, a quiet but dramatic transformation has taken place. The instruments of influence are no longer coups orchestrated in the shadows or invasions justified under Cold War rhetoric. They are contracts, infrastructure deals, oil shipments, and financial arrangements. Where Washington once sent Marines, Beijing now sends engineers. Where the U.S. once imposed political demands as the price of assistance, China offers investments with minimal conditions attached. It is through these seemingly mundane instruments of economic exchange that the balance of power begins to tilt. Venezuela is the most vivid case of this new method of geopolitical competition. Decades of U.S. sanctions designed to isolate Caracas and strangle its economy might once have brought the government to its knees. But instead of capitulating, Venezuela turned eastward. China stepped in with contracts that promised to buy oil, fund housing projects, and develop infrastructure. Each agreement was more than a business arrangement. It was a political statement that the United States no longer held a monopoly on survival strategies. Every deal signed was a blow to the narrative that sanctions meant isolation. This is the quiet revolution of global power. It does not unfold in dramatic battles or televised interventions. It unfolds in the language of commerce and finance. A long-term oil supply contract becomes a strategic alliance. A loan repayable in crude becomes an insurance policy against collapse. A port built by Chinese firms becomes a foothold in a region the United States once considered untouchable. The old tools of dominance, sanctions, blockades, threats, lose effectiveness when rivals offer alternatives. And those alternatives are dressed not in the rhetoric of ideology, but in the pragmatism of trade. The contrast could not be sharper. Washington often attaches political conditions to its assistance. It demands reforms, enforces austerity, and frames compliance as the cost of economic aid. China, by comparison, avoids political lectures. Its contracts focus on resources, repayment, and construction. This does not mean China acts out of generosity. Its motives are calculated, and its terms are designed to secure long-term access to resources and influence. But for nations long tired of Western dictates, the difference is profound. A deal without demands for regime change feels less like coercion and more like partnership, even if the balance of power favors Beijing. This shift in methods produces